For decades, investors and policymakers in the West lived by a comfortable script. We were told that Silicon Valley was an untouchable fortress of genius, the only place on Earth where true innovation could happen. We were told that China was merely a copycat nation, a giant assembly line that could replicate but never originate. But in 2025, that script hasn't just been flipped, it's been shredded. While the United States spent the last decade and trillions of dollars maintaining a global network of 850 military bases, China was busy building the world's most sophisticated innovation clusters. Today, the World Intellectual Property Organization ranks the Greater Bay Area, encompassing Shenzhen, Hong Kong, and Guangzhou, as the #1 tech hub on the planet, officially dethroning San Francisco. Are we witnessing the greatest wealth transfer in history? Are your investments still parked in a superpower that is being out-innovated in real time? Today, we're looking at the brutal financial reality that Washington is ignoring. This is the death of the copycat narrative and the birth of a new economic era. To understand why this shift is happening, we have to look at the data. For years, the Global Innovation Index was dominated by the US and Western Europe. But innovation isn't just about having a good idea in a garage in Palo Alto anymore. In the modern economy, innovation is defined by the speed of iteration. In Silicon Valley, the focus has shifted toward soft tech, apps, social media algorithms, and advertising platforms. These are high-margin businesses, yes, but they don't build the physical future. Meanwhile, China has mastered hard tech. They have created a closed-loop ecosystem where the scientist, the engineer, and the factory floor all live within a 10-mile radius. When you look at patent filings for 2024 and 2025, the gap is staggering. China isn't just filing more patents. They are filing the foundational patents for 6G, quantum computing, and solid-state batteries. For an investor, this is the ultimate leading indicator. Capital eventually flows to where the growth is most efficient. As we pull back the curtain on this new reality, we have to ask a difficult question. If the US is still the leader, why is it spending so much more on its military than its own labs? This brings us to the most expensive line item in the American budget. To understand why Silicon Valley is losing its edge, we have to look at where the money is actually going. We have to look at the 850 bases scattered across the globe and the massive opportunity cost they represent. In the world of finance, every investment is judged by its ROI, return on investment. If you are a CEO and you're spending 15% of your revenue on a legacy department that no longer yields growth, your shareholders will demand a pivot. But Washington isn't a corporation. It's an empire with a security reflex. Currently, the United States maintains approximately 850 military bases in 80 countries. To put that in perspective, the rest of the world combined has fewer than 100. In 2025, the U.S. defense budget has climbed toward the $900 billion mark. When you add in supplemental funding for overseas conflicts and veterans affairs, the total security spend pushes well past $1 trillion annually. But here is the brutal truth Jeffrey Sachs points out. This isn't just a military footprint. It's an economic anchor. Every dollar spent maintaining a base in a country that no longer wants it is a dollar not spent on the American power grid, not spent on high-speed rail, and not spent on the STEM education required to keep Silicon Valley competitive. While the U.S. is playing a 20th century game of territorial encirclement, the rest of the world has moved on to economic integration. The trap is that this military expansion creates a self-fulfilling prophecy. We build a base to ensure stability, which our competitors perceive as a threat. They respond by increasing their own defense, which leads Washington to demand more funding for more bases. This is what economists call unproductive capital. This money doesn't circulate back into the economy to create new technology or lower the cost of living. It sits in silos, literal and metaphorical, across the globe. Meanwhile, China, with only one official overseas base in Djibouti, has redirected that same scale of capital into the Belt and Road Initiative, building ports, railways, and digital infrastructure that force the world to trade with them, not us. For the investor, the math is sobering. The U.S. national debt is now a runaway train, fueled largely by the cost of maintaining this unipolar status. As interest rates remain higher for longer, the cost of servicing the debt for these 850 bases is beginning to crowd out the very private sector innovation that made America a superpower in the first place. We are essentially financing an empire while our domestic factory floor is crumbling. And this is where the crisis of the military budget meets the crisis of the laboratory. Because as the US focused on projecting power through hardware and hulls, it lost sight of the most important law of modern economics, the manufacturing innovation loop. You cannot design the future if you have forgotten how to build the present. There is a dangerous myth in Western business schools that says, "We do the thinking and they do the making." The idea was that the US would keep the high-value design jobs in Silicon Valley while outsourcing the dirty manufacturing to Asia. But as Professor Jeffrey Sachs explains, this logic is fundamentally flawed. In the real world, innovation and manufacturing are an inseparable loop. When you move the factory floor 6,000 miles away from the design lab, you break the feedback loop. You lose what engineers call tacit knowledge, the thousands of tiny, unwritten improvements that only happen when a designer walks down to the factory floor and sees a machine struggling with a specific part. China's secret weapon isn't just cheap labor anymore, it's density. In cities like Shenzhen, the person who designs the circuit board, the company that prints the board, and the factory that assembles the device are all in the same neighborhood. This allows Chinese firms to prototype, fail, and fix a product in 24 hours, while a company in California is still waiting for their FedEx shipment to clear customs. This speed is why the US is losing its lead in hard tech like drones, solar panels, and robotics. We kept the software, but we surrendered the physical reality. And in a world of 5G, autonomous vehicles, and renewable energy, physical reality is where the money is. As an investor, you have to realize that intellectual property is only valuable if you can defend your lead. But if your competitor is iterating 5 times faster than you because they own the machines, your patent is essentially a piece of paper documenting yesterday's technology. By the time you sue them, they've already released version 4.0. This brings us to an uncomfortable crossroad for the American economy. For 30 years, we've been told that offshoring was good for margins and good for shareholders. But now we see it has hollowed out our ability to innovate. I want to put this to you: if you had to choose today for a 10-year investment, would you rather own a company with the world's best software designers but no factories, or a company that owns the factories but is still learning the software? Be honest, where is the real moat in 2025? Tell me your choice in the comments, and let's see if we can reach a consensus on where the power actually lies. But if you're still skeptical about the power of the factory floor, you only need to look at one industry to see the devastation in real time. It's the industry that defined the 20th century American dream and is now being systematically dismantled by a new king of manufacturing. Let us look at the EV massacre and why even Tesla should be worried. If you want to see the manufacturing innovation loop in its most lethal form, look at the global automotive market. For a century, the internal combustion engine, ICE, was the pride of Western engineering. But the shift to electric vehicles didn't just change the fuel. It changed the entire financial architecture of transportation. While Western automakers were lobbying for more time to keep selling gas-powered SUVs, China made a massive, state-backed bet on the battery. Today, a single Chinese company, CATL, controls over 1/3 of the global EV battery market. Why does this matter for your portfolio? Because in an EV, The battery is 40% of the total cost of the vehicle. If you don't control the battery, you don't control the margins. Western giants like Ford, GM, and even Volkswagen are now in a financial death spiral. They are trying to build EVs using Chinese battery technology or expensive joint ventures, while Chinese companies like BYD are vertically integrated. BYD mines their own lithium, builds their own batteries, and designs their own semiconductors. In 2024, BYD overtook Tesla in total volume for the first time. But the real shock is the price. In China, you can buy a high-tech, 300-mile range EV for less than $12,000. In the US, the average price is over $50,000. Washington's response has been to slap 100% tariffs on Chinese EVs. As an investor, you must ask, is a 100% tariff a sign of strength? Or is it a financial iron curtain designed to hide the fact that our domestic industry is no longer competitive? Tariffs might save Detroit's profits in the short term, but they isolate the US consumer from the most innovative tech on the planet. This leads to a massive question for everyone watching. If the only way the US can compete is by doubling the price of its rivals' products through taxes, are tariffs a lifeline that will give American companies time to catch up? Or are they a death sentence that will make the US car industry a stagnant, overpriced island while the rest of the world drives the future? Drop your take below. Protectionism or free market competition? But the EV massacre is just one symptom of a larger disease. While China was mastering the hard tech of batteries and minerals, Silicon Valley was distracted by something much more profitable, but perhaps much more fragile. For the last 2 decades, Silicon Valley has followed a single mantra: software is eating the world. And from a purely financial perspective, it was a brilliant strategy. Software has zero marginal cost. Once you build an app, you can sell it 1 billion times. This created the era of the Magnificent Seven, the Googles, Metas, and Apples that now dominate the S&P 500. But while the US was perfecting the art of the attention economy, building algorithms to keep you scrolling, China was pivoting toward what they call hard tech. There is a fundamental difference in how these two superpowers view artificial intelligence. In the US, AI is seen through the lens of generative content, writing emails, creating art, and powering chatbots like the one you're watching now. In China, the state-led investment is focused on industrial AI, autonomous port cranes that move millions of tons without a human operator, AI-driven smart mining that reduces deaths and increases efficiency, high-speed rail systems that use AI to predict track maintenance before a bolt even loosens. As an investor, you have to look at the utility of the tech. Silicon Valley's AI is revolutionary for productivity, but China's AI is revolutionary for national power. We are currently in a software bubble where we believe that having the best large language model, LLM, is the same as being the world's most powerful economy. But if you have the best software and your rival has the best robotics, the best energy systems, and the best manufacturing, who actually controls the physical world? The US is betting that bits and bytes can control atoms and molecules. It's a massive gamble. But this isn't just a race between two tech hubs. This technological divergence is starting to tear the very fabric of global politics. Because when your rival has the technology that the rest of the world needs, the 5G, the green energy, the cheap EVs, they start to make friends that the US has relied on for a century. While tech hubs compete over patents, a much older battle is being waged over territory and influence. To understand the current tension, we have to revisit a policy from 1823, the Monroe Doctrine. Originally, this was a defensive message telling European empires to stay out of the Americas. But by 1904, it had evolved into the Roosevelt Corollary, where the US claimed the right to act as an international police power across the entire Western Hemisphere. For over a century, Washington treated the world as its own backyard. But in 2025, that imperial reflex is hitting a wall. Professor Jeffrey Sachs points out a stark contradiction that is alienating global allies. The US demands that no foreign military ever enters its hemisphere, yet it maintains 850 bases that effectively encircle Russia and China. When these nations object to a US military presence on their doorsteps, Washington labels them aggressive. This double standard is no longer working in a world where the US is no longer the only provider of security and capital. The reality of 2025 is that the global South, nations across Africa, Latin America, and Southeast Asia, is tired of being told who they can and cannot do business with. When Washington uses the Monroe Doctrine to pressure Brazil or Saudi Arabia to stop trading with China, these countries are looking at their own balance sheets. China is now the #1 trading partner for more than 120 countries. While the US offers military protection and 850 bases, China is offering 5G networks, high-speed rail, and massive infrastructure loans through the Belt and Road Initiative. By clinging to a 200-year-old doctrine of dominance, the US is inadvertently accelerating its own isolation. We are pushing the world's fastest-growing economies into a no-limits partnership with our rivals. For an investor, this means the Western Bloc is shrinking while the multipolar bloc is expanding. The 850 bases are still there, but the economic trade routes are moving around them. But this isn't just about ships and soldiers. The most powerful way the US enforced its dictates for the last century wasn't with a carrier strike group. It was with a bank account. As the world stops listening to Washington's political demands, they are also starting to question the operating system of the global economy. This leads us to the most controversial weapon in the American arsenal: the dollar. Imagine the global economy as a high-speed computer network. In this network, the US dollar isn't just a currency. It is the operating system. Because almost every major transaction, from oil in Saudi Arabia to copper in Chile, is settled in dollars. The United States has enjoyed what economists call exorbitant privilege. This privilege allowed Washington to run massive deficits and print money with the certainty that the rest of the world would always need to hold those dollars. However, a fundamental shift occurred when the operating system was turned into a strategic weapon. When the US and its allies froze $300 billion in Russian central bank reserves and disconnected major nations from the SWIFT payment system, they sent a chilling message to every Treasury Department on Earth. The message was, your savings are only safe as long as your foreign policy aligns with ours. Professor Jeffrey Sachs argues that this was the moment the dollar hegemony began to crack. In the world of finance, trust is the only real collateral. By weaponizing the global payment infrastructure, Washington inadvertently gave the rest of the world a massive, urgent incentive to build a backdoor. We are now witnessing the birth of a parallel financial universe. The BRICS Bridge, a blockchain-based payment system designed specifically to settle trade without touching a single US bank. The rise of gold. Central banks across the global South are dumping US treasuries at record speeds and replacing them with physical gold. Bilateral trade. Nations like China and Brazil or India and Russia are now settling billions of dollars in trade using their own local currencies. For the investor, the danger is currency reflux. If the world needs 20% or 30% fewer dollars to function, those trillions of excess dollars eventually have to go somewhere. They will flow back to the US, potentially triggering permanent inflation and forcing interest rates to stay high just to prevent a total currency collapse. The 850 military bases we discussed are designed to protect a world order that the financial system is currently fleeing. You can maintain a base in a country, but you cannot force the country's merchants to use your currency if they have a faster, cheaper, and politically neutral alternative. The irony is that the dollar weapon only works when you are the only game in town. But as the world diversifies its wallet, we have to look at the cold, hard math of why the US can no longer dictate terms to the other 96% of the planet. This brings us to the 14% reality check, a number that every Western investor needs to memorize. Numbers don't have a political bias. They describe the world as it is, not as we wish it to be. And the most important number for any global investor to understand in 2025 is 4.1%. That is the percentage of the human race that lives within the borders of the United States. For a long time, 4.1% of the population controlled nearly half of the world's wealth. But as Professor Jeffrey Sachs points out, we are living through a great rebalancing. Today, the U.S. share of global GDP has settled at roughly 14%, measured by purchasing power parity. This is the 14% reality. It means that 86% of the world's economic activity, 86% of the world's consumers, and 86% of the world's future growth are happening outside of the American system. While the West deals with aging populations and shrinking labor forces, the global South is hitting its stride. By 2050, 1 in 4 people on Earth will be African. India has already overtaken China as the world's most populous nation and is currently the fastest-growing major economy. When you look at the trade map, the results are staggering. China is now the leading trading partner for over 120 countries. From Brazil's iron ore to Saudi Arabia's oil to Nigeria's digital infrastructure, the world is increasingly trading with the world's factory, not the world's policeman. The danger for the average investor is home bias. Most Western portfolios are 80% to 90% invested in U.S. stocks. But if the U.S. only represents 14% of global output, being 90% invested there isn't safety. It's a massive bet on a shrinking slice of the pie. The 850 military bases we discussed are an attempt to maintain a 100% influence over a world where we only represent 14% of the economy. In finance, that is called over-leverage. You are trying to control too much with too little underlying capital. Eventually, the market forces a correction. But why isn't Washington adjusting to this new math? Why does the U.S. continue to use the same old tools of tariffs and sanctions even when the data shows they are failing? To understand the dangerous delusion of the current leadership, we have to look at the psychology of an empire that refuses to admit it has a peer. Believing you can stop a country of 1.4 billion people from innovating is what Jeffrey Sachs calls the dangerous delusion. In the halls of power in Washington, there is a persistent idea that if the U.S. simply chokes off enough technology, China's progress will freeze. We see this in the 100% tariffs on EVs and the aggressive bans on advanced semiconductors. But as any student of history knows, pressure often creates a diamond. Instead of slowing China down, these sanctions have acted as a massive national catalyst. Take Huawei as the prime example. In 2025, while the West thought they were crippled, Huawei and SMIC released the Kirin 9030, a 7-nanometer class chip that rivals the best in the world, produced entirely with a domestic supply chain. By trying to isolate them, we forced them to become self-reliant. We took a copycat and turned them into a main tire. This delusion extends beyond technology and into the way we interact with the world. While China sends engineers, scientists, and diplomats to build ports and 5G networks in the global South, the United States primarily sends generals, weapons, and military advisors. We are trying to solve 21st century economic competition with 20th century military hardware. For an investor, this creates a massive market blindness. If our leadership refuses to admit that China has a superior manufacturing model or more efficient energy systems, we cannot create the policies needed for American companies to actually compete. You cannot win a race if you are busy trying to trip your opponent instead of running faster. This brings us to a critical crossroads. History shows that when a dominant power refuses to accept a rising peer, it usually leads to total economic isolation or unnecessary conflict. Do you think the US can still pivot and choose to cooperate with China as an economic peer? Or has the dangerous delusion already pushed us too far toward an inevitable decoupling? In 10 years, will we have one global economy or two completely separate worlds? This is the most important question for your portfolio. Tell me your take below in the comments section. The question of coexistence isn't just for politicians. It's the blueprint for where you put your capital. As we look at these two diverging paths, you need a strategy. You need a roadmap to survive and thrive in a world where the old unipolar rules have been burned. Data is useless unless it changes your behavior. If you've followed the evidence through this journey, you realize that the world of 2025 requires a complete rethink of how we allocate capital. The old rules, where you could simply buy an S&P 500 index fund and wait for American hegemony to lift all boats, are being rewritten in real time. Navigating this multipolar era requires 3 specific shifts in your financial strategy. 1. Curing the home bias. Most Western investors are 90% exposed to a nation that represents only 14% of global GDP. To survive the next decade, you must follow the growth. This means looking seriously at the ASEAN nations, India, and the Greater Bay Area of China. These aren't emerging markets anymore. They are the new engines of global consumption. If your portfolio doesn't reflect where 86% of the world lives, you are betting against the math. 2. Atoms over bits. The software bubble taught us that code is profitable, but the manufacturing loop proves that physical infrastructure is powerful. As an investor, you should be looking for the companies that own the hard tech, the battery supply chains, the robotic dark factories, and the renewable energy grids. In a world of high inflation and currency wars, the entities that control the physical means of production will always hold more value than those that only control the attention economy. 3. The currency hedge. As the US continues to weaponize the dollar, de-dollarization isn't just a headline, it's a risk management necessity. Diversifying into hard assets like gold, or even considering the rise of central bank digital currencies, CBDCs, from neutral trade hubs, is no longer fringe thinking. It is a shield against a potential currency reflux that could devalue the dollar-denominated assets you've spent a lifetime building. Professor Jeffrey Sachs leaves us with one final, sobering thought. The US can remain the most secure and prosperous nation in history, but only if it chooses cooperation over dominance. If we keep spending trillions on 850 bases while our rivals spend trillions on 5G and high-speed rail, we are effectively subsidizing our own decline. The dangerous delusion ends when we realize that a multipolar world isn't a threat, it's a reality. As an investor, your job isn't to fix the world, but to see it clearly. The era of the sole superpower is over. The era of the smart, global investor has just begun. If this deep dive changed how you see your portfolio, hit the like button and subscribe for more macroeconomic analysis. Check the links in the description for the full Jeffrey Sachs interview and the datasets we used today. Thanks for watching, and I'll see you in the next one.